Okay, so this is now obviously lesson 2, and we've come from lesson 1. So let's just do a quick recap of what we did for lesson 1. So, lesson 1, we basically suggested that when we trade with lower leverage, it is safer. But obviously, if you can't trade with low leverage, being restricted by your capital, then obviously you are forced to trade with higher leverage so that you can open, position sizes that would fit your account based on your risk size. So we also then spoke about the risk management part of things, where we discussed what risk reward is, and most of us understood what risk reward is, and we understood that static risk is what we generally all know, is that we risk the same amount of money on every single trade, but then we introduced the factor of variable risk based on the outcome of individual trades over a series of 5 trades. So you'd reset your risk after the 5th trade or on the 6th trade. So, and then basically 3 levels of risk defined by yourself, whatever your appetite for risk is, level 1, 2, and 3. And then either you go up the ladder or down the ladder in terms of risk, based on if you win the trade or lose the trade. So that's what we discussed for lesson 2. And then we touched on basically what journaling is, how we can journal, what software we can use, what's the purpose of the journal, what do we put in the journal. And I gave you guys a book to read at your own discretion. And that book was this one over here. If anyone does want this book emailed to them, I can also email the book to them if they have difficulty. I'm again not forcing you all to try or use Notion. This web page that you can access is nice because everything that I'm showing you here is laid out in this format that we're going to learn by. So it is nice to use the Notion like I've used it on the web page. If you can't access Notion, you should email me. Any problems you have with Notion, you should email me so that I know that you can read through what we've done. And obviously, the video upload is done on the Telegram group. Okay, so that is what we should have done. Okay, so again, I told you guys there wasn't much homework to do for the specific lesson. You just had to understand what the different types or higher or lower leverage would do for you and how it plays out with larger accounts and smaller accounts. And obviously, the key takeaway was the variable risk management system over a series of trades. And we also saw that we knew that the risk rewards was, with a smaller risk reward, we need to be higher accuracy. But when we used variable risk, we could see the outcome was far less. So we could have a lower accuracy and still be profitable by using variable risk as opposed to using static risk. Okay. And then that was basically lesson 1. Hopefully everyone, understood what lesson 1 was. You've maybe watched the video again if you had time, or if you didn't have time and you're still waiting to watch it, that's fine too. And you'll maybe have questions later on. Again, this is an ongoing process of learning. So it's up to us as the individuals to make sure that, we commit to, looking again at the work that we've gone through at the lesson. I'm trying to, I don't like to use the term, but I am spoon feeding all of you as best as I can. And, at the end of the day, I can only spoon feed you so much. The rest is up to you guys as individuals to do the rest for yourself. So to make this learning more streamlined. So I'm going to start off by asking, is there anyone in this room right now or in this lesson that is on Zoom that would like to ask any questions relating to lesson 1? Is there anyone with questions? So no one's got questions. Okay, no one
Not for now.
emailed. Yeah, Sivakaran, you've got a question?
No, I was saying not for now.
Okay, I'm just checking the chat here. There's no questions in the chat. There's no email questions I have. And there's no questions in the Telegram group that we have. Okay, perfect. So there's no questions. If you have questions, you can always ask a question either when I'm finished teaching what I'm going to teach, or email me or ask in Telegram. That's how you should ask questions. Okay, so obviously now we're going to start lesson 2. And one of the important things to start off by learning what you are learning and by learning price action is to understand what the abbreviations are and what they mean. Okay, so maybe there is quite a lot of them. There's like 40 or so of them, or maybe more. Didn't actually count them, but there's a lot of them. Okay, and you've probably seen other ICT traders mark their charts up with these, or you've seen me mark it up, or other people in other groups mark it up. But as a general rule, that we all should know what this abbreviations mean. And you can come here to this page that I've sent in the group chat, and you can basically go through all of this. And I'll actually just post this in the group as well, on the Telegram group, so you guys can remember it. But I would suggest that if you don't know all of these, it is quite essential that you do learn them, and maybe you take, like, I don't know, 5 a week, and just remember the abbreviations, like remember those 5 for that week, and then take a new 5 the next week and learn those 5 off by heart, and so you can memorize them, so that when you view a chart from someone, you'll know exactly what these abbreviations mean. And obviously you're going to learn how they impact price, what effect they have on price, what they do for us as ICT traders, and maybe how to trade them or use them as a reference tool. But they are essentially what we refer to as our price action indicators. As ICT traders, we don't trade with moving averages or trend lines or harmonics, patterns, all of that stuff. We are trading price action, and because we don't use indicators, these are our indicators. Okay, so if you haven't, or learned these, you should definitely learn them. It might take you a while to learn them off by heart. I think it took me about a month or so to learn them when I first started, so it shouldn't take you much longer. It's really quite easy, I would think, to learn what the abbreviations are, and you guys should definitely take some time to learn these. Is this new to anyone here in this group? Has anyone not seen this before? Has anyone not seen any of these abbreviations?
I've seen some of them, but then there's also some that I haven't seen before.
Yes, that would be expected, Timotopia.
Yeah.
I'm saying your name right, Timotopia, right?
Yeah, you got it.
Okay, so yeah, you've probably seen some of them, and some of them you likely would not have seen. Okay, so some of the ones maybe you've probably seen is like, maybe IPTA or FVG. These are the common ones. Maybe a buy side imbalance, sell side imbalance. But there's maybe others that you haven't seen, like an SP, which is just a stop purge, or a DOL, which is a draw on liquidity. So there would definitely be new ones that you would basically just have to learn. It will take you some time, but it's good to know these, because while you may not be understanding all of them at once, it's always good to, have them inside, because in the future I'm going to mark up some charts, share some charts with you guys, and then you're going to be able to ask me or tell me or associate what that abbreviation is on the chart. Okay. So that's basically what the purpose of learning all of this is. And obviously everyone knows what an OB is, because that's probably the most significant one that everyone knows when they think about ICT. That's what made him famous, is the order block. Okay, so all of these are important. Some you may use, some you may not use. That's really how your strategy will pan out in the future. But yeah, they are important to learn. Okay, so I'm not going to spend much time there. You can always come back here and learn them yourself. But for starting off over here, so we talked about the risk, we talked about journaling, and the next step in sort of laying that foundation to how we can become traders, how we can find consistency, how we can identify some sort of pattern or strategy that we can create or formulate from what we learn, is by having this sound understanding of foundational phases of what it is to become a trader. So can anyone tell me, before I show you this over here, before you can read it, I'm just going to minimize this. Can anyone tell me what their belief is? Okay, whoever wants to put their hand up here, or tell me what they think the difference between a trading system versus a trading strategy is. Can anyone think off the top of their head what they believe to be the difference? Sivakaran, can you answer?
Okay, to me, a trading strategy is something that we frame to enter into a trade. Example, it could be SMC concepts or order block concepts or QMR or based on harmonics or a confluence or a combined strategy of all these three. Anything could be a trading strategy. Basically, how a trader wants to enter into a trade.
Okay. And this trading system?
I mean, I come from IT, so to me, this trading system, it looks like since it has a system, so it could be. Uh, uh, is it related to any trading applications or something like that?
It can be, but it's not limited to that. It wouldn't be only limited to like a system in terms of an application or piece of software that you'd use. So I know that, I also come from an IT background. I'm actually a network engineer. So the word system to us would represent some kind of, maybe an application or some written code that needs to be developed or created or used. So it's not really the same, but we can think of the word system as the whole entire piece that makes up trading, like the whole system. Whereas
Okay.
the strategy would be specifically maybe what it is that we are going to do to get the results, like the consistency. So like maybe you want to trade order blocks or use a fib application and get a discount and then take a entry based on this two things, and then that would be like your trading strategy. Whereas the trading system would be, how you get there to get to the strategy. So it would be the first steps that you'd have to take. Roger, are you here?
I'm here, Darren. I'm here. Yeah.
What are
For me,
what's your thoughts about the two trading
it
systems?
was similar to what now. In terms of, for me, I feel trading strategy would be particularly to what I would be looking in charge, a certain strategy that forms part of my model in terms of how I want to trade. And that's for me trading strategy. And I feel trading system encompasses all of that, and as well as how you operate and in terms of being a trader and what are the things you're looking for to see in charge. And I would guess some psychological stuff in there, because system doesn't always mean like you just explained now. So yeah, that's my feel on that.
Okay, fair enough. One of you had your hand up now, but I see you removed it. Was it one of the Emmanuels that had your hand up?
Yes, it's me. Good morning, everyone.
Go ahead.
You rather call me M2 because we got two Emmanuels here.
M2,
Yeah,
okay. No
it's more
problem.
likely for what you say. Yeah. Yeah, you rather call me M2. So it's more likely on what you're saying. The trading system, it's a combination of everything, psychologically, strategy. I mean, include everything. That's a trading system. Now, when we talk about strategy, it's a method that you use, that you combine to make a good trade. I don't know what you think about that. Was one of my thoughts.
Okay, thanks for your 2 cents worth, or maybe more. M 2 cents worth. Thanks, Emmanuel. Okay, guys, so basically you guys are thinking on the right track as to what the differences between a system versus a strategy would mean. But let's take a look here, and we can think that this is important because before I teach you concept, and we are obviously going to learn a lot of concept because we would start probably in the next phase of this lesson, we'd start learning some of the stuff over here. But before we get to that, we need to start thinking how we are going to use this information. So this goes hand in hand with learning about risk, because before you even trade, you need to know what risk would mean, what margin would mean, what leverage would mean, because without that, you're sort of walking in blindly. Okay, so that lays the foundation. So just like those things lay the foundation, this too lays that foundation. We need to understand that everyone says, oh, we just need a trading strategy to take trades. Okay, all very well. We've got a trading strategy of whatever it is. Maybe we found one on YouTube, or we read a book, or Samson said this, or Marcus said that, or John said this, whatever's working for them. But he can give you that strategy, or I can give you that strategy, or anyone else in this group can give you a strategy. But that does not mean that because I am working with that strategy and you go and take that same strategy, that you can make it work for yourself. Okay, and that is what the problem is with trading, is that although there's so many hundreds of strategies out there that's available freely or paid, okay, the point of them not working, or the real reason why they don't work, is because there's no system behind the strategy. And they don't tell you this when you trying to use the strategy. They just say, oh, just do X, Y, and Z, and then A, B, C will be the result. Okay, all very well, risk reward applied, risk management, etc., etc. But there's no step-by-step process with which we use to find if that strategy is the strategy that we see on the chart right now. Okay, and that's the point of the trading system. The trading system is to guide you, so in a way, in a step-by-step way, that you can formulate that either A, this is my strategy that I see on the chart in the price action right now, or B, it is not my strategy because, A, B, and C has not happened, or X, Y, and Z has not happened. So there is criteria to be met for our system, so that, yes, we can apply our strategy to our system. And just like M2 Emmanuel said, and Roger, and I think also you, Sivakaran, all basically understood that this whole system encompasses not only just what our strategy is going to be, but it is related to what are we trading, what is our psychology. So all of this system is journaled. This is a piece of your journal. Okay, so again, your system and your strategy and your journal all technically encompass one thing. Okay, and that one thing will lead you to finding trades, meeting specific criteria, to looking for trades, reasons why we take the trades, confirmations, the purpose of it. Okay, so if we look here, the system is it's fixed, and it maps out the overall process. Just like we said, when you apply your strategy to your system, your strategy is variable. So now what that effectively means is that your system is static. It does not change the way you find your strategy. So you've got steps 1 to 10 to look if your strategy is there on the chart. Your strategy is there. You know what your strategy is. That can change based on the time frame, what you're looking for. Is it a strategy that's available now? Is it not a strategy that's available now? That's variable. Whereas the system is fixed. Okay. So the fixed system, which is the trading system, okay, answers what and why you trade. Whereas the trading strategy answers how you are going to trade. How are you going to take the trade? Is it an order block? Is it a void? Is it a discount? Is it a turtle soup? What kind of trade is it? That's basically, what your strategy would entail. But you can't have a strategy if you don't have a system. So this is my guidance to you to help you to build a system. You can build a system from today. You can start building a system. It's going to take you maybe a couple of days. Sit down, think about it, write it out, type it out, whatever is going to suit you. But there's no better time to start than now. Okay, so you need to develop yourself a system. You can do it from day one. You don't need to know all those abbreviations we discussed, or what this is, or what that is, or there's a lot of information I'm still going to teach you. That can all be built into the system, and then once you've got your system, you can then build your trading strategy. But you need to have a system. Okay, so things that would be part of your system is that once you've taken your amount of trades that you're going to take, maybe on a daily basis, on a weekly basis, you, at the end of that week, or maybe even potentially at the end of the month, up to you, you're going to build into your system an ASR. An ASR is an advanced, you've probably heard this maybe, it's an advanced self-review. So basically you're going to review the trades that you took prior in the previous week, previous day, however often you want to basically review your trades. That's entirely up to you. but built into your system is some kind of daily or weekly workflow. Okay, so the workflow, you guys have probably maybe worked at some companies where they discuss or talk about, how can we improve a workflow. A workflow is basically like what we are discussing here in terms of the system. So the workflow is a step-by-step guideline process of how we do business in the business we are doing. I was in IT. We used to help a lot of customers developing a workflow with different system implementation suites, Office and Active Directories, server-based things. So there's a lot of workflow that basically was integrated into their company that they wouldn't know was working in the background because it was designed by someone. So here we are designing our own system, our own workflow to formulate basically in the future what our trading strategy will be based on using the system. Okay, so I see you have hands up. Before I go on here, Temitope, you've got your hand up.
Yes, thank you, Darren. Just one quick question on the system in terms of what and why you trade. I've seen some people like decide to only trade some pairs, like gold, for example, or any like USD or anything like that. What guidance would you give someone completely new to decide which pairs they actually trade? I'm assuming that's the like what you trade in terms of like what pairs, or did I understand that wrong?
So, no, you're right. So over here, the fixed system answers
Mhm.
what and why you trade. So
Yeah.
what are you trading? I'm trading gold, I'm trading oil, I'm trading stocks, I'm trading bonds. That's what you're trading, right? So as part of your system, you would choose what you want to trade. Maybe it's your time zone allows you maybe to only trade, say, New York sessions, or
Mhm.
if you wanted to trade a currency, that would be suited to maybe like a EU or maybe Australian dollar because of the time that you're in. Whereas if you wanted to choose a commodity, maybe you prefer to trade gold, or maybe someone likes to follow what oil does and they like to trade oil. So before we've even come to the strategy part of things of what we look for on the actual chart, our system tells us we trade gold or we trade whatever, silver,
Mhm.
Bitcoin. Okay, that is some kind of what that we are trading.
Yeah.
Okay.
Yeah. And for sorry, for someone that's like completely new and doesn't have that what yet, what guidance would you give them to say this can help you find your what?
Okay, so we'll get into strategy and like looking at
Oh,
charts and
apologies.
price action and things like that.
Cool. Mm.
But it's really going to come down to building the system. So that what that we are trading right now, you may leave
Mhm.
it blank because you may not know the answer to that question as of right now. You don't know what you want
Yeah.
to trade, okay? And that's
Mhm.
fine. You don't need to know, but that what could be later gold or GU or EU or whatever it is that you're going to prefer to trade, okay?
Yeah.
Once you learn all of the concept, then you can go through the concept and associate those concepts to price action on the chart. And then based on what you see, you might find a liking towards gold or towards
Mhm.
oil, or different price action signatures that occur in specific markets are different. I can't tell one person to trade GU because I trade GU. They must decide for themselves what works
Mhm.
best for them. And that comes down to learning later a specific one or two things. So we're not going to, as traders, that what doesn't mean what 20 different pairs or 20 different items that you're looking at. The less is the more. So I generally recommend to most people is that to find the strategy or to take trades or the what that we are trading must be generally one thing. Focus on that one thing. And if you want later on, once it becomes, more easier for you to understand what you're doing, then add something else as that second what. Okay. But for now,
Mhm.
that one thing that is the what must be one thing. Okay. That could be whatever
Okay.
maybe you tried to trade in the past. And even if you don't know anything about trading, that can still be left blank. The purpose now is to build the system part of things. So again, the what is really irrelevant for now, at least.
Okay, cool. Makes sense. Thank you.
Trivakaran, you've also got a question. You got your hand up.
Yes, yes, yeah. I'm still not clear on the difference between a system and a strategy. Example, when I say I trade gold only during NY session, is it a system or a strategy?
You trade gold during the New York session.
Yeah.
Okay, that's part of a system because that's what you're trading. Okay.
Oh, okay.
You didn't tell me how you were taking trades, right? You didn't say that. You said you were trading what? Gold, right?
Yes.
You didn't
Yeah.
tell me taking trades based on an order block on a 4-hour time frame, and then on a 1 hour I'm going to look for an entry on a void or something like that. You didn't tell me how you're taking those trades. You only told me what. So that's part of your system. It's your system to trade gold. And if you've got that what piece figured out, then that is already one of the first steps as part of your system.
Okay. Okay.
Okay, so that is your system. So let's just finish this up.
Thank you.
Okay, guys, it's not going to take too much longer, and then we're going to start getting into the concept over here. So like I said, your system is based on what and why, and your trading strategy is based on how. How are you going to take the trades, which would come later. You don't have a strategy right now, and that's fine. Or if you do, maybe you want to improve it with a few elements of the system. Okay, but everyone needs to have a journal, they need to have a system, and they need to have a strategy to take trades. Without those three things, then what it is that you are doing is going to be sporadic. You're going to do this today, something else tomorrow, next week you're going to try something different. And if you don't have a set out step-by-step process of what it is that you are doing, then because there's inconsistency in the application, there will be inconsistency in the results. Okay, so that's the reason that we learn what a trading system versus a trading strategy is. And here I've created some simple to follow steps. You guys again can go and copy this if you want, if you wish to, but at the end of the day, this process to how you create your system is going to be independent and different to each of us. No one can say that you have to do all 9 steps to formulate a trade as part of your strategy. It is the way in which we get to the strategy to say yes or no, I should take the trade. Okay, so creating and developing a strategy will be done once you have a system in place. Okay, so all very well, you think you have a strategy and you do X, Y, and Z when A, B, and C happens. Okay, but how do you know that your strategy is likely to work out because you haven't followed the step-by-step plan to say that this is my strategy? Because sometimes maybe it looks like it's part of your strategy. You take the trade and you're like, I'm not sure if it actually worked out, if it was different this time. But if your system is in place, you know what to do, then you apply your system to your strategy to your system, and the trade doesn't work out. At least you know for a fact that you went through all the steps of your system, your strategy was applied to your system, and then the trade doesn't work out. Well, then that's fine. It didn't work out that time. But if you don't have the system and the strategy, then every time you lose, you're going to left wondering, is my strategy broken? Should I try a new strategy? So all of these things is what you're going to basically go through as a psychology, emotional type of being. These are the things that we need to have figured out before we take trades. Okay, so this is just some examples. But here, I think it was you, Temetopi, who asked this, what would be step 1, browsing assets, maybe gold, oil, silver, whatever, or currencies. And if you're trading more than one, so you're going to browse. Step 1 is to browse of what you've chosen. Maybe you've chosen 2 or 3 assets or currencies that you're going to look through. And of those 3, step 2 is to browse a specific pair, okay, across maybe multiple time frames, and you found a sort of replica of what you like to look for, and that would be you done in step 2 over here, basically. So that would be step 2 of your system. Step 3 find a single currency or asset which you identify as a possible trade scenario. So you basically have chosen of your 3 currencies or whatever, and basically now you've narrowed that search down, okay? And you're going to basically play out the scenario on the chart. Is it something you like to trade, not like to trade? Step 4, wait for price to trade into a tradable zone once confirmation or confluence criteria has been met. So right now, as of right now, most of you wouldn't know what the difference between confirmation or confluence is, which you'll learn later, okay? But basically, we are waiting for price to come into that zone, whether it's a buy or sell, and then when it gets there, does it meet the criteria to enter the trade? That would be a step 4. Okay, so this system, you can see we're doing this all the time. We are trying to take the trade, that we are taking the trade based on the strategy, but how do we get to that strategy to play out? We do it in this step-by-step process. Okay, hopefully you all follow here, and I'm not boring you for too much longer because we'll get into the nice charts over here shortly. Okay, but step 5 over here, we would identify areas where price would likely to go to and from, which we designate as take profit zones. So before we've actually even taken the trade, okay, before it even gets into the area we want to buy or sell, if we were to enter the trade, we should already know that if we were going to enter this trade, and let's say price came in there and we did enter it, where are we going to take profits or scale out of this trade? So this is all decisions that we need to have thought of before we've even taken the trade. Okay, because your strategy, maybe your strategy says, oh, I'm just going to take profit at 1 to 3 or 2% gain or whatever, but that's very myopic, that view, okay, because you can't just expect from the market that whenever you enter a trade, you're always just going to get 2% or 1%, or your strategy tells you, I'm just going to hold until I get 2%. You shouldn't think like that, because the market is dynamic and we should always pay ourselves as the market makes money available to us. So this is where that rule or that step of our system comes in, is that before we've entered the trade, if we enter it, where we're going to take profits. Okay, obviously, as part of our system, we should understand that there is position sizing and risk reward that is associated to this trade that we would eventually take in the future when our strategy is formulated. So it's part of the step-by-step system. The step-by-step system here, this, for example, step 6, is not telling us how much position sizing, how much risk reward the strategy allows us to get. It's merely saying or suggesting that part of the step 6 process is to think how much position sizing and what is the RR expectation or risk reward expectation. Okay. Step 7, trade entry on execution or pending order. So that's something you can decide. Do you want to, before price gets there, do you want to maybe put a order in place, or only when it gets there maybe set a price alert and then come and sit down at the chart or look on your phone if you want to take a trade execution rather than a pending order? But again, your system tells you to either make the decision based on either an execution or a pending order. That would be step 7. Now again, it's not limited to only step 9, okay? It could be 5 steps, okay, or more. It's really up to each of us as individuals to create our own system here. This is just an example of what it is that I'm showing you. So basically, step 8, continuing here, trade management. Well, is there any price action that must occur for the trade to be invalid, or will you hold till the stop loss is taken? Okay, so this is all part of that trade management aspect, which is part of step 8 in your system. Okay, again, you'll get to the part where there's the strategy, but for now, step 8 would be the trade management. Step 9 would be, once the trade has exited, you're going to document all aspects. technical aspects like what the charts look like, the emotional part, how you felt before entering the trade, how you felt after taking the trade, and psychological, and maybe any other useful information that would be beneficial to you later on when you go through the trades. So that's like a step-by-step process. I'm just going to quickly show you one of mine. So this is something I go through. So daily, I'm going to look at a daily trade checklist, for example, higher time frame PDAs to be marked. And again, you don't have to follow this because you might not know anything I'm showing you here, but this is my guidelines of what I follow. So I'm doing step-by-step process on a daily. Mondays, I do specific things over here, and you can always come and view this again, but this is the specific things I do on a Monday. Tuesday, the weekly open, a potential high or low of the week will be created, and Tuesday to Friday is basically where I'm looking to take trades, and they are generally forming between London open 1 or 2 hours in between. I'm having a bias for the week, and basically this is the process that I'm taking to get to find an entry for the week. And then basically this is my documentation process of the outcomes of those trades. Okay, guys, so this is my workflow, as I was mentioning, and basically this is what I do from basically all the way from Sunday, Monday, right up until basically the market. So for me, that's a Thursday, and I don't really that often trade on a Friday. So this is my step-by-step checklist. Now, again, this is not something you should copy because my strategy, the way I take trades, my system is going to be different to yours. But later, I'm going to show you how I basically take a trade or look for a trade or identify a trade, and then either you can copy me, do whatever you want, but you'll be able to do the exact same thing and know what it is that you are doing. Because it's all very well you come to the chart on, say, whenever you sit, either being a Sunday or a Monday, and now you go and sit there for an hour. What are you doing in that hour's worth of sitting? Because now let's say you're limited to only 1 hour or 2 hours. So within that 1 or 2 hours, are you immediately sitting, browsing the charts and clicking buy or sell, or just placing orders here and there? Or are you having this filtering process of criterias that need to be met so that you can actually apply your system to the chart? Okay, I don't run in on Monday morning as soon as the market opens and crazily looking at all time frames, all my pairs that I look at, trying to hurry into the market. I don't do that. I don't actually even care sometimes to take a trade on a Monday, most of the time. And like, for example, today is July 4th, which is an American holiday, so the market would be quite thin today, and it's being a Monday, I'm not expecting too much from the market. So as part of the system that I go through, okay, I have the step-by-step system with, now it's obviously ingrained into my head, so I know exactly what I need to do and how I do it to get to apply my strategy to the chart. And that's just something I've done for many years. So my system is static, it doesn't change. Whereas my strategy is variable because maybe I'm entering off of a 1 minute, a 5 minute price actions dynamic. Not every price action is the same. Not every outcome of every price action is the same. So there's many variables when it comes to our actual strategy, whereas the system is static. Okay, so that's going to wrap it up now for what we define as our system versus the strategy. Does anyone have any questions regarding the system, the trading system, how to create it, what it is? No one's got questions? Anyone's got questions?
I think from my side there, thanks. It's been, Shavit, you've laid it out quite nicely, and it's a lot of help for me, even though I'm not asking a lot of questions. You've been answering questions that I've had without having me to ask it. So thanks.
Okay, perfect. Let's see. Thivakaran, does it maybe shed some more light on now your difference in understanding between strategy and system?
Yes, sir. I'm clear now.
Okay, perfect. So do you right now, Thivakaran, have a strategy at work that tells you how you're going to trade gold right now?
Yeah.
Okay. And let's say Monday morning starts. Do you know that from the time you sit till the time you execute the trade, do you know exactly what you need to do to find a setup on your chart?
Yes, I do.
Okay. And is this all written down, or is this just something you've done so often that it's sort of just like second nature now?
I mean, it's not completely written down, but I have that in my mind. I go with the higher time frame analysis, and I will wait actually in lower time frame so that price reaches to that level, and I take my trade at that point of time.
Okay, that's interesting that because maybe not other people in this channel right now would be at that specific level of understanding what it is they need to do when they sit down at the chart. But let's just question it, Thivakaran. So, for example, when you sit at the chart for gold and you're about to enter, or maybe it's like 30 minutes before your entry at the New York session on gold, do you know that what type of trade it's going to be, like where your target for price is going to be? Do you know before taking the trade, do you know where the target is?
Yes, then I know. I mean,
Okay.
if, example, if in the New York session, if the ASEAN high or low has been already taken, and assume if the price is going towards the opposite direction, so at least I will wait half of the level for the Asian high to mitigate it.
Okay, that's fine. And do you know from the setups that you've taken, either win or either lost, that what type of trade it's going to be? Like, does it executable? Is it an executable trade, or do you normally put limits or buy stops or sell stops on your trades?
Sometimes I put limit orders, but sometimes I mostly sit and watch in front of the system. If I don't have any work, I mean, this is not my full time profession.
Mhm.
So if say if the zone that the point of zone it is if it is going to be very big, right, and if it's going to be if it's going to be a stop hit, and mostly my stop loss level is around 100 or 150 100 or $1.5 only. And so if it is going to be beyond that, right, I don't put sell orders and limit orders, I believe. I mean I don't directly put limit orders, rather I would wait when the price hits half of the zone, I take the orders.
Okay. And does every trade that you take have a predefined position size?
No, no. Right now, my account size is very small, so I go with only micro lots only, 0.01 and 0.02.
Okay.
Since I'm just new to trading,
Okay. And is every trade setup that you take the same in terms of the stop loss placement and the size of the stop loss versus the reward part, or is it different?
okay. Frankly, I go with the one. My risk reward ratio is 1:3, and this stop loss position, right? It is not same across all the trades. If say if price is coming to that zone, uh, and I see if there are any some liquidities already there, then my stop loss I'm ready to go with huge stop losses. But if the price is say it is coming like how to say, if it's coming without creating any liquidity, but it's just coming, right, my stop loss size is less only.
Okay, perfect. Well, thanks for sharing with us, Sivakaran. I appreciate it. Okay, guys, so I'm not going to
Thanks.
spend much more time over here in terms of the system versus the strategy. We need to start investigating what this means for us. And like Sivakaran, maybe not everyone has something that they are looking for in terms of either the pair that they're going to trade, what they're going to trade, and you're still trying to figure that part out. And most of us maybe would be in that position, and maybe he's been on the charts for much longer than some of us, and he's liked gold. Okay, now maybe others will take a liking to forex or whatever it is that you're going to trade. So luckily, whatever we're going to learn here is going to be applicable to assets in terms of the broad spectrum. We could trade pretty much anything that we wanted to in terms of what we're going to learn. Okay, so don't feel left out in terms of what it is that you're going to trade. That's going to come later. We are going to look at what price action is right now. So that's where we're going to start with next. And you can always come back to this over here as a guideline. You can always ask me questions. You can rewatch this video, email me, telegram me. You really need to have a system in place. Without a system and a strategy applied to the system, it's sort of, you know, what it is that we are doing with that time. And most of us probably have either a part-time job or full-time job and only partially trading where we can get time. Okay, and I'm not expecting everyone to just drop their job now and become traders. It's a process. You can't just do that. You need to pay bills, you need to live, and you can't expect the markets to do that for you starting out. So the system helps us to become to that level. We have that organized, and without that organizational aspect, how can we ever think that the market can provide us consistent results if we are not willing to put in that time to create and develop this system? Okay, so that system, the design starts right now. We can immediately after this lesson either start typing one out, drawing one out, you know, whatever, writing one out, but sit for an hour, focus on yourself and try and write something step by step down. That's your homework, guys, is to think of everything that goes through, or, you know, whatever you were doing before when you were taking a trade. Think of all the things that was happening in the back of your mind, or maybe risk, maybe emotion, all of these things. You write them down, and every possible outcome and scenario that is likely to play out is probably part of your system more so than it is part of your actual strategy. Okay, so without further ado, I'm going to continue over here. Does anyone, before I move on, have any other further questions? No further questions.
No.
Okay. Okay, perfect, guys. So I'm just going to get a little whiteboard out over here. I'm going to ask you a question in the meantime while I'm busy opening this application. What market conditions are there based on either what you know, what you've read, what you think you know? What are the market conditions? Does anyone want to put their hand up and answer that? No one's brave enough.
I think, Darren, I'll take a stab at it. I mean, you get different market conditions. You get trending markets. I mean, you get consolidation. I don't know if I'm on the right track here. Consolidating markets. I don't know if that's the type of conditions that you're referring to. You get a bullish markets. I'm not sure if that's exactly what you are referring to.
No,
But it's different types.
you're sort of hitting the nail on its head almost.
Okay.
Sorry guys, I'm just trying to open this whiteboard here, but it seems to have been stuck here. Does anyone else have anything to add to that in terms of what the conditions of the market are? Or the phases, maybe, the cycles that we go through, anything like this?
As well, I will add, okay, sorry, you go for it.
So consolidation, expansion, retracement, and reversal. Is it the one that you are expecting?
Where did you learn that from? Was that you? Sorry?
Sorry?
Where did
Sorry?
where did you learn that from, Divakaran?
It's from my basic class.
Okay, well, yeah, you're pretty much right. So before we even like start to understand any other concept, we should understand that there's only really 4 types of things that we can see on our chart in terms of whatever we want to classify them as: cycles, phases, conditions, whatever we want to associate that name tag to. There's only 4 of them, and you just said them. And those 4 things are consolidations, expansions, retracements, and reversals. Okay, so hopefully we can all see my screen right now. So if everyone would agree with me that when price is sort of moving like this, okay, there's different names for it, okay. That's a really raw depiction, but there'd be others. So like sometimes the market can go into a sort of a consolidation like this too, okay. And what a lot of people think is that this is like whatever. If you've studied Wyckoff, it's like phase 1, phase 2, but I don't teach Wyckoff, okay? I teach ICT, and consolidation is consolidation, regardless of, you know, time frames, whatever the case may be, okay? Consolidation is consolidation, and the market is in only 4 conditions. Either it's in a consolidation, either it's in an expansion, or either it is in a retracement, or either it's in a reversal. Okay, so which is the abbreviation CE, which is consolidation, expansion, retracement, and reversal. Okay, so we can sort of, again, you'll probably hear other people refer to them, or maybe not other people, as cycles, phases, stages, conditions, but in a nutshell, they're all meaning the same thing, okay? And I'm just going to call them the types of markets that we are basically in. We're either in a consolidation, we're either in expansion, we're either retracing, or we're either reversing. Okay, so step 1 of any market is always to come out of a consolidation. So that is a C, that is a consolidation. So anytime the market is going to do sort of anything, whether it be a 1-minute time frame, a 5-minute, it's generally going to start from a consolidation. Okay, does everyone follow? Hopefully you all follow and understand what a consolidation looks like. It's generally, consolidation is like also classified as a ranging market, if you would like to call it that, or maybe you know it as that, but that's basically it's sideways price action without any clear move up or down. It's basically just trading sideways, as we also give it the nickname. So that is a consolidation, okay? And we refer to as the consolidation as number 1 of the entire phase of the market, or the stage, or the condition, as step 1, okay? Step 2 would be the expansion phase over here, which is the E part, which is expansion. So when the market is in a consolidation, we expect after this consolidation for price to expand away from that consolidation, okay? And I'm not teaching you right now about how do we know which way it's going to expand. Is it going to expand higher? Is it going to expand lower? I'm not teaching you that right now, because you can learn that later on, but I will shed some light on it briefly. But the market will always be in consolidation first, and after a consolidation, we come into the next phase, which is expansion, okay? And there's no rule that says either reversal or retracement is going to be next. So these are interchangeable. 3 and 4 is interchangeable over here, meaning either the market is retracing or either the market's going to reverse. Okay, so from the consolidation, we get expansion, and once it's done consolidation and expansion, it can either do reversal, retracement, or retracement, reversal. But just know that step 1, 2, and then either 3 or 4, or 4 and 3 can take place. That is really what's important in terms of understanding consolidations, expansions, retracements, and reversals. How we know which way it's likely to expand, well, that would be based on things you'll learn in future, but it would likely be based on the higher time frame, because while one time frame's retracement could be another time frame's reversal. Okay, so let's say that over here, this is phase one of the market over here. This is a consolidation, right? And we can clearly see that it's a consolidation. It's sort of just ranging over here. And price decided that over here, it was going to expand away from this consolidation over here. Okay, we would identify that it has expanded outside of this consolidation over here. So there's a consolidation here, and over here, which is basically now number 2, this is expanding. Okay, but what you'll often find is that if this is a consolidation and this expands away from that consolidation, how do we know how far down this is going to go? And again, this would come from your higher time frame, because while this could be, let's say, a daily chart, a 4-hour chart, a 1-hour chart, the time frame right now is not really as relevant as it is identifying what's going on here. And what we identify is that it came from a consolidation. And generally, the purpose of the consolidation is to collect orders, right? So when it's consolidating like this and ranging, there's liquidity over here, liquidity over here, liquidity over here, and so on. So there's obviously both buyers and sellers inside of this market. So the market is collecting orders, it's consolidating, it's a collection of orders. And then the market likely wants to expand away from that consolidation, and we will only know which way it is likely to expand based off of the higher time frame. So let's say that came from a consolidation, it went into expansion. Now, because it's in an expansion, does this mean it's going to continue lower, or does this mean this is just a retracement? Because the next phase is important. Either it's 3 or 4. So if it's 3 and this is just retracement based on the higher time frame, because if we were to zoom out here, perhaps the market came from a low over here, something like that. So the market had rallied higher, went into consolidation, and from this consolidation, it expanded lower away from the consolidation over here. But after expanding away from the consolidation, is this retracing or is it reversing? So it's likely that because of what happened in terms of price action going up over here on the higher time frame, that step 3 over here is actually retracement. So step 3 is retracement taking place over here. And once the market's retraced, again, it's not to say that it must do something specifically next, because the market can do the following. Now that we've learned what step 1, 2, and either 3 or 4 is, the market can do the following. It can consolidate and expand. That's a given. We know that it does that. But after it's consolidated and expands, the market can either go back to a consolidation over here and start to consolidate again, or after expanding, it can just do a complete reversal and trade straight up like that. Okay, there's no given rule of which condition the market will do after expansion. One thing is a given though, that the market will never consolidate step 1, move on to step 2 over here, and then go back to step 1. So it will never consolidate, expand, and consolidate. Okay? The purpose is to understand that after expansion, what phase are we in of the market that we are looking at? And this represents why I've not really associated a time frame to this, is because it can happen on any time frame. It can be a 1-minute chart, 5-minute, 5-day, 5-month, any chart. It can happen on any chart. Price is fractal, so whatever I'm teaching you on 1 minute can be a 1 hour, a 1 day, a 1 month. It's fractal. Okay, so consolidation is a given. expansion is a given, and after consolidation and expansion, is the market retracing or is the market reversing? Okay, so obviously you guys are going to have some questions, and I already see there it's a Vakaran. You've got a question, go ahead. Vakaran, question?
Oh, sorry, I was on mute. Okay. You are telling price, the nature of price is fractal, right? Can you tell me, or can you explain what is that fractal, the meaning of the fractal in terms of price?
Okay, pretty easy, right? So if I wrote here in big letters, this is H4, right? What does that mean? It's 4-hour chart, right? That we're
4
looking
hour.
at. Okay, but if I wrote here without you seeing H4 and you just joined the meeting, this could be very well be a 1-hour chart, not so? Not so?
Okay.
So without me showing you a time frame, you won't know what time frame that is. It's
Yeah, I won't know.
it's fractal. The only reason why you associate time to the chart is because it says H4, H1, M30, M1. You associate a time frame to whatever chart you're looking at. But all in all, price is fractal, meaning if you see an order block on a 1-minute chart and you see an order block on a daily chart, it's an order block nonetheless. However, obviously the 1-minute order block is not as effective as the daily order block. Or you see a void on a 5-minute chart and you trade the void on a 5-minute chart, it's not as significant as, say, the void on a monthly chart, for example. It's fractal, meaning whatever you learn on one time frame or without a time frame even attached to it, it's the same meaning for everything else. So it's the same here as this consolidation and expansion and reversal and retracement. Do you understand?
Okay, so it's going to be constant, but the impact varies from time to time.
The varying impact level would be associated to the actual time frame that you're looking at. But part of this teaching, what I'm talking about now, the word fractal isn't really associated to this teaching. It's just a given that we should know what fractal means. So the meaning of when I say price is fractal really just means that without showing a specific time frame, any price action that I teach you can be used, taught, or learnt from any time frame. It's fractal.
Okay.
Okay, guys. So it's interesting though that you did bring that up, Sivakran. Thanks, because this leads me to the next thing. So if, for example, we looked at a daily chart and we said that based on the daily time frame, price has gone higher over here. Now, again, I'm not showing you these to deter you from trading because you don't know it yet, but there's likely to be an objective maybe somewhere over here in this area as to why price wanted to go lower first only to then go higher. Not only because they sell to buy, but maybe there was a void there on a higher time frame. Maybe it's you pulled a fibs and there was a discount. Maybe there's an order block there. Maybe there's some sort of inefficiency taking place. So there's many reasons as to why price came to this specific level over here before rallying. Okay, but that's not for this teaching. Okay, you can apply this teaching to things you learn later on. All I'm teaching you right now is the phase of the market that we associated to what we saw in the price action. So phase 1, we saw that price was consolidating. Then number 2, price expanded away from that consolidation. And step 3, we completely reversed over here from that area. Now, generally, a big difference from retracement and reversal is that with the retracement, price is just basically pulling back before either going high or continuing its basic direction that it was going based on the higher time frame. Whereas with a reversal, there needs to be some kind of liquidity that would be present. Okay, and we're right now learning liquidity just yet, but you probably, most of you have an understanding of what liquidity would be. And basically liquidity would be buy side liquidity, sell side liquidity, equal highs, equal lows, swing highs, swing lows. That's where liquidity would be. And reversals are likely to occur where there would be liquidity. And the reason for that is because obviously if you understand the whole buy side liquidity, sell side liquidity is you are selling to the buy stops and buying to the sell stops. So that's the whole paradigm shift between ICT, market maker theory, and just general trend line, support, resistance, retail stuff. Okay, so we think like market makers in terms of what liquidity is and the purpose of it. And whereas we're not looking at, oh, there was a trend line or a EMA bounce or anything like that. We're looking at price action only. So step one, consolidation. Step two, always expansion. Those two are given. And in step three, we don't know what is going to happen. Is it retracing? Okay. Or is it reversing? And you'll have to actually come back to this specific teaching to know which scenario it's likely to be in. Because just like I explained over here, this was likely maybe a retracement on one time frame, but a reversal on another. So just because step three says it's retracing on a daily, this could be a 1 hour reversal or a 15-minute reversal, but on a daily, on a 4 hour, this is just retracing. Does everyone understand that while one time frame's consolidation may be another time frame's expansion? Does everyone understand that way of thinking? Is there anyone who has any questions regarding that way of thinking? When I say one time frame's X is another time frame's Y, does everyone have that sort of understanding?
Yeah, Darren. So it's like, just for understanding's sake, so the daily time frame could be in consolidation, but on the 1 hour it could be an expansion.
Yeah, exactly, 100%. So like if we just go a little bit down over here, away from what we drew here, okay, and we drew this sort of range or consolidation over here, okay, this could be like a, maybe a daily or a weekly consolidation taking place, right? So we've seen there that it's sort of trading in this range, right? Now, if we were to come to the 1 hour or the 4 hour, these like big range markets where it's not really trading away or moving higher or expanding, these massive moves here on one time frame is quite big on lower time frames. But in terms of the weekly, it's contracted, consolidated, it's not really doing too much on that time frame. But in another time frame, this is huge expansions. So that's what I mean by that term, and it seems to you've caught on, Roger, that one time frame's consolidation. So weekly consolidation, but daily maybe, 4 hour maybe, expansions, huge expansions. Okay, and it's the same with what we said about if this is a consolidation, one time frame is a consolidation, could be another time frame's expansion. I'll get to your question now, Temitope. So over here, let's say the market was pushing higher over here, and it stopped pushing higher for whatever reason and started to go down over here, right? So on one time frame, maybe there was liquidity over there and price decided to take this liquidity over here. This would be, say, a reversal. So while this over here is a reversal on a 1 hour, a reversal on a 15-minute because it raided that potential liquidity point for whatever reason, this move lower over here is a reversal on that 1 hour or a reversal on a 15-minute, but very likely that on the daily, the 4 hour, this is just retracing to then, well, go higher over here. So I'm not trying to say that's the swing high, that's the swing low, that's the higher low, that's the higher, because that way of thinking is not what I'm showing you here. I'm showing you how to read the market in terms of price action. And this is a very foundational phase of reading the market, understanding the market is what cycle or what do we identify as what's happening on the chart. Go ahead, Temitope, you've got a question.
Yes, thank you. So with the that structure that you put at the top in terms of like retractment, expansion, and reversal, or which one or which time frame? Because I've watched your YouTube videos and you said that like the higher time frame governs kind of the lower time frames. So to know which state the market is in, would you be looking at more so the daily? Because for example, if daily is in contraction but 1 hour is in expansion, like I'm not sure if I'm making sense, but which one essentially tells us which state the market is in?
Okay, so there's other work ethics or other industries, if you will, where X is equal to X and Y is equal to Y. So it's sort of objective versus subjective, right? So do you know the
Yeah.
difference between objective and subjective?
Yes, I think so.
Okay, what do you understand about the two?
So subjective is more based on like opinion, whereas objective is based on like facts, I think.
Okay, so this is a scenario where the understanding of consolidation, expansion, retracement, and reversal is objective, right?
Mm-hmm.
But your application to put it onto the chart is subjective, whereas
Okay.
you're interpreting that this is a retracement. Okay, you
Mhm.
understand what consolidation, expansion, retracement, reversal is. That's objective because we both then understand what CERR stands for, right? But
Yeah.
it's subjective that you're thinking it's reversing and I'm thinking it's retracing, because while you're trading a reversal based on a 1 hour, 15 or whatever, and you're in the trade for a sell at, and your target's like 30 pips lower, you could be right there, but I could be subjective and say, I'm just saying this is a retracement and I'm in, I don't know, somewhere down here and I'm
Mhm.
waiting for my buy limit, or I've taken a buy, but based on a higher time frame for an expansion higher based on a higher time frame. So
Okay.
once you understand what the CERR represents, okay,
Mhm.
coupled with what we'll understand later about what we call, which is simple way of thinking. Many people don't know this. This is obviously stands for higher time frame, but
Mhm.
what we'll learn is that there's actually a sequence to this. So just like you said, which time frame do we look at that gives us order flow, and what I've taught on YouTube, and that's something I don't go into detail about, but that's called higher time frame sequencing, where,
Okay.
for example, if we're looking at the daily chart for a possible entry, a possible objective, and we enter off, let's say, the 4 hour or the 1 hour, what time
Mhm.
frame do we look to take profits at? And that is called higher time frame sequencing, which is MWD, which is monthly, weekly, daily. I'm veering
Okay.
off topic now, but this is essentially how we would formulate the trade idea based on what we see on the charts using higher time frame sequencing. So while you entered off a 4 hour imbalance or 4 hour
Mhm.
order block, you'd look for a daily or a 1 hour objective. That would be a higher
Okay.
time frame sequence, because all the time frames are is the same time frame, but just many time frames condensed into the one time frame. So all the time
Mhm.
frames are the same essentially. It's
Yeah.
just more candles, more data, but they're all telling you a bigger story. Okay,
Yeah.
so that story has many swings and different chapters, and it's the overall idea of the story is the same. The plot's the same. It's just how we get to the plot. Okay, so that's higher time frame sequencing. So objective versus subjective.
Mhm.
It sort of rules out when you learn ICT about that whole objective subjective, because you understand the concept and that's the concept. There's no like variation in the concept. Okay, so either you know it or either you don't. That's objective.
Mhm.
Subjective part is, that's a bearish order block. No, that's a bullish order block, because you're looking at a 4 hour, I'm looking at a daily. So that part is subjective. I'm taking a swing, you're taking a scalp. We can't
Mhm.
we can't be on the same wavelengths, because you're just trading now and I'm trading now until next week kind of thing. So
Yeah.
that part is subjective, and the objective part is learning the concept, because that's what it is. It doesn't change.
Cool. Makes sense. Thank you.
Okay, guys, so like I said, CE stands for consolidation, expansion, step 1, step 2. We don't know after step 2 what could take place. It could be, number 3 could be a retracement, then step 4 could be a reversal, we don't know what's going to happen. It's really dependent on the time frame. But this is one of those videos where you may want to come back to, because this is going to have a lot of emphasis when you start to understand more concept and more data as to this is an order block, that's a mitigation, that's a reclaim block, this is a retracement because the weekly says that this void needs to be closed and there's a daily swing low that needs to be rated on the liquidity of the sell side to go higher into expansion. Now, what I just said may not make entire sense to you, because it probably won't, and you need to learn more. But this is really the beginning stages. So your homework would be to learn what consolidation, how to identify it, expansion, what it is, how to identify it, retracement, reversal. And I'm going to send you guys notes on the specific topic over here, which will shed some more light on this exact idea. Okay, guys, so I'm going to continue now with this teaching, and these are the 4 phases that we need to understand. 4 phases, stages, conditions, whatever you want to refer to them as, this is what you're going to see in any market, any time frame, whatever time frame you look at, you're going to see this. Okay, and you'll be able to, once you know what each of the phases are, understand what is the phase that we are in, or the stage that we are in. Because once you can identify the stage or the phase that we are in, you can sort of build your strategy around that phase. You know what it is that you're looking for, when to take your entry. And it's not something that you're going to see if I ever show you charts that I label, because this is sort of just something when you get to that point. Once you learned this, it's something you just know. Like, you'll sit on the chart, you know what to look for, and then you just basically say, is the market consolidating, is it expanding, is it retracing, is it reversing? So just quickly show you an example over here on this area here of a particular pair I trade, and this is GU over here. So again, this comes down to understanding consolidation, expansion, retracement, reversal. And what we can say about this whole area of price action over here is that it was consolidating. It wasn't really moving too much higher, too much lower. It made a high, it made a low. Now, what we can say is that it expanded over here outside of this consolidation once over here. Okay, and then what did it do? Well, it grabbed this liquidity of that equal low. So what did I say about a reversal signature and price action? Is that if this is a reversal over here, then there needs to be some kind of liquidity grab. So there was a liquidity grab based on this low, and price consolidated. It expanded into this liquidity, and then it reversed. Now again, is it retracement? Is it reversal? So on this particular time frame, maybe a reversal over here, and we got in the trade, and our profit target was potentially this high over here, okay, or maybe a void over here, okay, or maybe some kind of other time frames order block over here. Maybe we bought somewhere down here or close over here, and our target was higher up because we were buying in some kind of discount and we were taking profits in some kind of premium. Okay, so this was one time frame's reversal, but another time frame's retracement over here. So if we look at sort of what the 4-hour maybe would represent in that price action, so it came lower. There was that consolidation we saw on the 4-hour over here, and then we see it basically trade lower than that consolidation, and then price reversed. Okay, so when it basically traded higher, does that mean that this reversal changed the entire 4-hour or daily sort of bias that was unfolding? No, it didn't. It didn't change that bias. All that happened was that it was a reversal on, say, a 1 minute, a 5 minute, a 15-minute reversal, but a retracement on a 4-hour, or a retracement on a daily. So this 4-hour, we can see here that sure, it dips below, it reversed there. If you can see that on the 4-hour, it's also technically, if we bought there, it would be trading a reversal. And over here, this is just a retracement to go lower. Why? Because it's sell to buy and buy to sell over here, which is a higher time frame target of a liquidity point over here. Why that liquidity point? Because there is impulsive price action over here. These big voids that are created are impulsive price actions, and those have large liquidity pools sitting below them. These impulsive price actions over here. Don't really worry too much of what you see labeled on my chart, because you'll learn all of this later on. But basically what I'm showing you is, let's just get a clean chart over here, make it a bit easier to follow. So we said that on that 4-hour time frame, it was retracing over here. What was it retracing into? Well, we could have said that these two up close candles over here was some kind of order block over here, maybe something else on the daily over there. So price would have traded lower and then retraced the next day. So what did it retrace into? Well, one time frame's retracement is another time frame's expansion, or one time frame's reversal is another time frame's retracement. One time frame's consolidation is another time frame's expansion. Okay, so if we look here, price expanded lower and it consolidated over here on that lower time frames. And then what did it do? It rallied higher. What did it rally higher into? Well, it retraced into this daily void over here. And I'm not putting an emphasis on voids or order blocks or anything in specific, but objectives, we could call them, or points of interest, POIs, as some people like to call them. These are areas of interest for liquidity, market makers, imbalance, rebalance, and that's how we associate price action. So it reversed, retraced, and expanded. So again, if we look at what we said here, consolidate, expand, retrace, reverse, or reverse and retrace. The market, after reversing or retracing, again, now that 3 and 4 has occurred, it can actually go back to consolidation or back to expansion. So 3, 4, 2, or 1, or 1 and then 2. We don't know what comes after 3 and 4, but that's the likely events that unfold after a retracement or reversal. It either goes back into expansion or it can go back into consolidation. Okay, and that happens very often. So if we look at what happened prior, what happened over, let's say on this 4-hour chart, we could really just pick any time. Okay, so price consolidated, it expanded over here. So when it expanded over here, okay, this is an expansion from this consolidation, and when it landed sort of over here to this low over there, there's actually a reason why, would be based on a higher time frame, which is this little guy over there. This is an imbalance that you don't see, but I'll show it to you now. There's also what? Liquidity on that swing low over there, because that's a big long-term swing low, and below every swing low, the longer it's lasting in the market that hasn't been tapped into would sit liquidity, and then price traded in here and basically stopped there and then went higher. So we could classify that this traded into this zone, which is actually this over here. There's an imbalance there. Let's just pull this way. You can see there, price traded into this imbalance and this swing low. So it paired up those sell side liquidities with this imbalance, and then price stopped going lower. So we can classify that the market expanded, and after taking that low on this daily chart, there was a reversal here. So one time frame's reversal potentially is another time frame's retracement. So when it made this low, price traded higher, and where did it trade back to? Sort of this position over there. So maybe what you see here is that it traded into the low, took the liquidity, rebalanced that void from previous price action, and then this big wick over here was basically either a reversal on one time frame or a retracement on another. So daily was a reversal, maybe 4 hour was a reversal, but on this weekly, this is likely retracement. This is not a complete reversal of the trend, and from this point it's definitely going to reverse and go higher all the way up to here, because now we believe X, Y, and Z. The markets, we can't predict that. All we can do is trade the price action that we see. So all that we see here is that price expanded, took the liquidity, it then either reversed or retraced depending on which time frame we saw it from. And where did it come to? Well, it basically came to this point over here, which is a higher time frame of a weekly imbalance, closed that imbalance, and then basically decided to go lower. The next week came, took the week's high over here, and then basically price continued its order flow to go down over here. And again, one time frame's retracement, another time frame's reversal, one time frame's consolidation, another time frame's expansion. There's no set rule basically to say that it must be a reversal on all time frames because it's showing a reversal on the daily, or it's showing a reversal on the 15. We must understand that price is fractal, and each time frame tells its own story of what it's doing based off of the bias from a higher time frame. So if we look at what basically that means for us over here, is that it's sort of like a framework, right? The CERR, okay? And it's like a framework to tell us what is the nature of price action. It's expanding, it's retracing, reversing, consolidating, you know, that's sort of what we identify in terms of what price is doing right now as we sit at the chart, okay? So this is something that's very important. We'll often in the future revisit this, okay? And this is the following: a liquidity reference point, and I'm actually going to type this out because it's going to be LRP or IRP. And liquidity reference point and IRP, which is institutional reference point, is an interchangeable term that basically means the exact same thing, and that is order block, void gap, and old high and low. That's basically your three institutional reference points. So what we can say here is number one would be your old high. Oopsie, number one would be old high. Number two would be sort of order block, so that would be OB, and then number three would be what? Your void or your gap. So liquidity void or fair value gap. Those are your three institutional / liquidity reference points. And we'll often, like I say, revisit these because they have a significance on price action on all time frames. And those are the three institutional or liquidity reference points. So they are reasons to get into a trade, and they are also reasons to exit a trade. We are basically learning characteristics of price action here. Whether we trade 5 minute, 1 day, 1 hour, doesn't really matter. If we can identify what characteristic it is of the market, well, great. Then we can just continue to do what either we were doing or learn something new here. But I'm going to ask everyone in the future what a liquidity reference point is, or what is an institutional reference point. And if you can say one is old high, okay, sorry, old high, and obviously the reverse of that would be old low over here. So you've got an old high and or old low, and you've got an order block, and you've got a liquidity void / fair value gap. Okay, and the reason why is, if you can think of what a institutional reference point is basically the following. So if we look and draw this price action out in a very rough sketch, it is price goes up and then it goes down basically over here. So what is that? It's an old high over here, and they bought over here going up in this price section. So that's an old high. This over here would be our order block. So that would be our OB. And because that is the case, and they did sell into the up move because it's a buy to sell, then what's likely to happen is either it keeps going lower or it retraces into the order block and basically sells again, either retracing into the fair value gap or creating a liquidity void over here. So those are our three institutional or liquidity reference points: 1 old high, 2 OB, and 3 fair value gap and void, or actually really interchangeable. One time frame's liquidity void could be another time frame's fair value gap. One time frame's fair value gap could be another time frame's liquidity void. Those are three institutional or liquidity reference points. Has anyone heard of the term institutional reference point, liquidity reference point? Is this new to anyone? Can anyone speak up? If don't be shy, we're all here to learn. First time anyone's heard this.
New to me.
Yes, yes. For me, it's new, like first time hearing about it. And
Okay.
Yeah, I've heard of them all, except for say the difference between the fair value gap and the liquidity void. I think that's what I'm not clear about.
Okay, well, to classify that, Emmanuel, is really simple. Fair value gap is really the same as a liquidity void. The only difference is that, like I said, if it's a fair value gap with a small inefficiency, then that might be a larger inefficiency on a lower time frame. So I'll show that to you in price action over here. Let's look at the daily chart on any given pair. Let's look at this, for example, and over here on, let's say, the higher time frame. Okay, so over here we see that this over here is a daily gap over here, right? So that's a fair value gap. Okay, but let's say on the weekly there might only be, sorry, this is a liquidity void, and on this chart would be a small fair value gap, possibly. You can see how much narrower that would be over here. Oopsie, from there to there. So while the lower time frame has got a large void or imbalance of price, the higher time frame has got a very small price that is imbalanced. So fair value gap is generally something smaller, whereas a liquidity void is an expansion, much higher expansion than just a fair value gap. But yeah, that's not the point of this lesson. I will go into more detail what each of those items are, old highs, old lows, because that's actually part of your premium and discount array. So don't worry too much right now about what's the difference between a void or a fair value gap, because you'll learn the ins and outs later on. Okay, but I was just going through what we need to know in terms of the consolidation, expansion, retracement, and reversal. Okay, again, all of these notes are listed over here, so we at any point can come in here and read this. But over here, all moves, like I said, start with consolidation. The direction with the most liquidity absorption is likely the intent. Okay, so that means that where there's likely to be more liquidity is where the direction is likely to go, because what I say here about liquidity absorption is that it has to run into that liquidity to absorb those sell stops or absorb those buy stops. That's what we mean by liquidity absorption. And generally the market moves towards where liquidity would likely be. And that's not like 1 minute liquidity or 5 minute liquidity. It's higher time frame. Yeah, sure, it will raid equal highs, equal lows, swing high, swing low on all time frames, but the higher time frame is likely where the most liquidity will be. Okay, so that's where liquidity would be, and then order flow would basically tell us what sort of direction or bias do we expect price to continue going in. Is it just continuing to sell? And if it's selling on, say, monthly and weekly, then it's likely that just the 4 hour and the daily are retracing. Okay, and eventually that 4 hour and daily will go in towards the weekly bearish order flow. So weekly has got a bearish order flow, but daily and 4 hour are bullish. So that just means daily and 4 hour are retracing into the next time frame, which comes part of your higher time frame sequence. So H4, D1, bullish, weekly bearish. So H4 D1, what's the next time frame higher than H4 and D1? Week 1. So weekly is bearish and 4-hour daily is bullish. So 4-hour daily is bullish into the weekly bearish, and from the weekly bearish we will start to see on the lower time frame a continuation of that trend lower. Now that's probably something most of you wouldn't have ever known, and that's why you are taking these lessons, and that is part of higher time frame sequencing, which is what you'll learn later on. But for now, that's effectively what we are going on. So over here, what is expansion? Okay, expansion is an order block. Okay, an order block's near some sort of equilibrium point. Okay, so when we drew this price action over here, and we said, let's just go back here. When price decides to expand over here, where did I draw it? Over here. Okay, so if price is in a consolidation over here and it shows a reason to expand away from the consolidation, there is likely some kind of order block inside of this consolidation where it may want to return back to before going lower. Okay, and that is referred to as the RTO, which is return to origin, okay, or aka return to order, okay, but I say origin because it is really the origin of the move, okay, and both can have an RTO because there could be an RTO over here and there could be an RTO over here, but you'd be trading in the direction of the higher time frame. So again, this could be a 4-hour or a 1-hour that's selling, expanding, number 2 going lower, but you could be part of that expansion lower for 30-40 pips, but the overall trend when price gets to 0.3 over here for reversal, this is part of the higher trend, so therefore there is more pip value or percentage value in gain for price to go higher, because it's in actual fact it's expanding lower, but it's actually going to reverse and expand higher on another time frame in the direction of the order flow. Okay, so that's what we mean by expansion over here. Retracement, okay, a liquidity void. Price moves back to institutional reference, okay, repriced to levels not efficiently traded. So someone asked me now, what is liquidity void? There we go. Liquidity void is basically an impulsive move higher with a large up or down close candle that is inefficiently traded. So it's not like small little gaps, like I said, it's a large closing candle, not generally with a wick either. It's generally a candle that expands much higher, closes higher, and that is a liquidity void, whereas a fair value gap would be just a imbalance of where price has not traded to efficiently. Okay, and generally if price expands in a particular direction of bullish or bearish, and it will likely create expansions in that direction, which is generally what a liquidity void is. It's showing expansion, and if it's not traded efficiently, it needs to be traded efficiently, and that is what we refer to as retracement. Okay, so it expands in one direction, and then what happens? It retraces that inefficiency, and then likely what? Expand higher because it's retraced. That retracement is part of that liquidity void. So when it's expanding higher, it's easy to see. That is retracement. Reversals, like I said, there needs to be some kind of liquidity pool present. Okay, price moves against the current direction. So like I said, with your time frames, 1 hour is bearish, 15 minutes bearish, but 4-hour and daily is bullish. So it's likely that price is seeking those points of liquidity, old lows, old highs, equal lows, swing high, swing low. That pool of liquidity is really where it's targeting, and when it reaches into that liquidity pool, that's where the reversals will likely take place, or aka turtle soup territory. Okay, turtle soup is basically just a fake move below an old low or above an old high, and then price reverses above that old high or above or below that old low. That is what we refer to as a turtle soup. Okay. Yeah, it's basically just referencing what I said anyway, what these would effectively mean. Consolidation, equilibrium. Equilibrium is the 50% of an entire range. It's halfway point, basically. And we are waiting for impulsive moves away from equilibrium to tell us that that's an expansion. So you measure 50%, and then when price moves away aggressively from an expansion out of that consolidation, that is where your equilibrium point is. Okay, so everything that I'm teaching you, just like ICT says in one of the very first things, is words. I'm going to teach you a crap load of stuff, and all you need to do as the student is to pick one of them, which is the same model I'm teaching here. Everything I'm showing you must be understood so that at a later stage you can just use one or two of these things that you're learning. You can't use everything I'm teaching you on one setup or one chart or one strategy. You're going to mix and match, choose what you like, choose what you don't like, and use it for your own advantage. Okay, that is really the purpose here, is to understand the price action. And once I understand price action, then you can sort of formulate your one or two things that you like and see in price action, and then that can form part of later your strategy that you look for, because it's impossible to trade everything on one chart, marking up everything and trading everything. That's just unrealistic. You cannot do that. Okay, and then there was just some other notes here that I've written for us, which is, like I said, institutional reference points, also referred to as a liquidity reference points. Okay, so this, I'm sure we can all understand that there's a difference between retail, what retail does, retail patterns, M patterns, head and shoulder patterns, but basically that's how retail traders trade. They don't trade price action because they believe that the head and shoulders is the price action, when it's not. That is the inducement by the market maker, the institutions, so that they can induce people to see these patterns, harmonics, trend lines, all of that. That is an inducement by the institution to engineer liquidity. So a couple of weeks ago, I've got an example of this over here. I actually think I sent it to Matesh. He asked me what I think about Euro USD, and I hadn't been trading it for a while, but I had a markup of the chart. Let me just pull it up here for you guys. I can basically explain to you what I saw or what I was thinking over here. So this is Matesh. He's actually in these sessions over here. And I basically said to him that I was expecting Euro USD to continue bearish over here. And there was some long-term low that had not been taken, which is from 2016 October month. And you can see here it's sort of designed or engineered some equal lows over here. And that's sort of like support, if you will, from the retail's perspective. So they'd be trying to buy this. Meanwhile, I'd be looking to sell it because, I wouldn't be selling right at the bottom. I'd wait for it to retrace and then sell it, but that would still be my bias because it's a draw on liquidity, DOL, draw on liquidity over here. And then basically I said that from this point over here, we should expect price to take this low and trade lower. So that would be this ultimate low down here. And that's basically what we saw from Euro USD, because we had the higher time frame. So if we look over here, Euro USD, it still has not taken that liquidity point over here all the way back. So I would still say that it would likely want to target this liquidity, and it's actually still engineering, because if we look over here in the current price action, it's not taking this low, and this low did not take the previous low of October 2016. And in fact, it's actually just creating liquidity here, which is still liquidity from all the way back there, which is more liquidity over here, which is more liquidity all the way over here. So it is engineering liquidity. So what's likely to happen, it induces people to buy this, and then they think, oh, well, it's hit support, so it must be buying. And then basically price sort of just does that, goes up higher, and then only to crash down back into the liquidity over there, because it is inducing people to take trades based off of support and resistance, supply, demand, trend lines, whatever else they see, I don't know, head and shoulders or whatever they're seeing. And that is an inducement by the market makers, because the market makers are the only ones who can move price. So all of the people in the world who trade, let's say there's whatever, I don't know, 100 million people in the world who trade, and all of their accounts combined has no effect on price, because all of that money combined of all of the accounts, if I've got a $10,000 account, Matesh has got $1,000, someone else has got a $50,000 account, all of that money combined is nowhere near the amount of money that the institutions have at their disposal to manipulate and move price. And that's just how it is. Okay, so I think I'm not going to teach this because this requires a very high level of understanding right now, and I don't feel that is sort of where everyone is at right now. So I'm going to leave these for next time. They are important concepts, but I think that really the key takeaway here for today is understanding and building your system, and understanding this foundational phase of what phase of the market we are in. I'm going to send also an additional video regarding this consolidation, expansion, retracement, reversal, and we can discuss it further next time. But I feel like if I move on here into these two, then we're not going to get the best understanding we can, because everyone's like rushed. Okay, and I still feel like people are still coming from last lesson on Friday. So there's time, guys. Don't rush everything, and these are important things to understand. But just as these are important, we mustn't forget the important things that come before everything that becomes important later on. So it's sort of a stepping stone, and we can't force ourselves to, do what we need to do if we don't understand what we need to do first. So first we need to understand the basics, the foundation phases, and then once we understand these things, then we can move on. There's no point me just blasting through all of this content and everyone gets left behind in the dust. And some of you may be up to par with what I've explained so far. Some of you may have lots of questions, but I'm doing this for the greater good of everyone, not just the select few who may understand where we are right now. And that's basically where we are right now. So I'm going to open up now just for 1 or 2 questions before we end off. Does anyone right now, based on what I've spoken about and for the last 40 minutes about consolidations, expansions, etc., anyone have any questions? Alex, you've been in the lesson the whole time, but you're rather quiet. Are you following? Are you happy? Are you here?
Yes, I am.
Okay. Any questions from your side?
Today's lesson pretty much quite heavy, I believe. Quite a lot to learn.
I didn't catch that, Alex. What did you say?
Oh, I see today you cover quite a lot in terms of ICT perspective. So ICT is quite new to me, so there are pretty much things for me to learn.
Yeah, that's the specific reason, and there's not only you in the group that has that same issue. So I don't feel like I should move on as part of this teaching to learn these other two, because it's very important that we understand what I've spoken about over here. And again, guys, this I'll send it to you in the group again, but all of this information and all of these notes that we should take down is available in this link that I send on the group. Okay, so Temitope, you happy? You have any questions?
Yeah, no, all good with me. I just wanted to finalize on the homework, because I made some notes. I just wanted to like see if what I've written down is what you want us from homework.
what you
So-
want from us, sorry, from us.
Okay, so start by designing the system. Like I said, like
Yep.
that can start immediately. You can start having that thought process of what you need to do. And then in terms of what we just finished off now with was the CER part. So all you need to do is get a couple of charts together, and then you guys can send me some screenshots and we can go over what is and what isn't what we've identified. You know, consolidation, expansion, retracement, reversal. And that's just it. There's nothing too fancy we have to do. We just have to do
Cool.
that. And then obviously just remembering the institutional reference points, because we'll always revisit those much later on all the time. Okay, guys.
Thank you, Darren.
Okay, guys. Well, that's it for then today, and we'll meet